This is an audit report. 47 pages of accounting tables, footnotes, and reconciliation statements from the London Bullion Market Association's annual vault certification process. The document is dense, technical, and designed to be unreadable by anyone without specialized training in precious metals custody accounting. I read it anyway. And buried on page 34, in footnote 17, I found a number that should have made headlines around the world. Reconciliation variance of 7,464 metric tons attributable to legacy classification methodologies and inter-vault transfer timing differences. 7,464 metric tons. Convert to ounces. There are 32,150.7 troy ounces per metric ton, and you get 240 million ounces. 240 million ounces of silver that the LBMA reported as being in London vaults doesn't reconcile with actual physical counts. An accounting error representing 29% of annual global mine production. A variance worth $21 billion at current prices. The report was published at 4 a.m. London time on Wednesday, the timing that ensures minimum market attention. No press release accompanied it. No analyst call was scheduled. The LBMA simply uploaded the document to an obscure section of their website and moved on, hoping no one would notice. Someone noticed. This is the story of what the LBMA is calling an accounting error, and what it actually reveals about the silver that's supposed to back the paper claims traded in London every day. Here's what they're not telling you. The LBMA doesn't publish real-time vault holdings. Unlike COMEX, which reports daily inventory changes, the LBMA releases aggregate vault data quarterly, with a 3-month lag. The numbers are rounded, aggregated, and provided without granular detail that would allow independent verification. This opacity is by design. The London market operates on trust. Participants trust that when a bullion bank says it holds silver on behalf of clients, that silver exists. Participants trust that when metal is sold unallocated, the bank has sufficient inventory to satisfy withdrawal requests. The entire system functions on the assumption that reported holdings match physical reality. The annual audit is supposed to verify that assumption. Independent auditors, in this case Ernst & Young, examine vault holdings, reconcile records with physical counts, and certify that the numbers reported to the market are accurate. This year's audit found they're not accurate, by 240 million ounces. The footnote attributes the variance to legacy classification methodologies. Let me translate that from accounting speak to English. For years, the LBMA allowed vaults to classify silver using different standards. Some vaults counted silver that was in transit between facilities as present in both the origin and destination. Some vaults counted silver pledged as collateral for loans as both held and lent. Some vaults used book entries rather than physical counts, trusting that electronic records matched physical holdings. These classification inconsistencies accumulated. Each year, small variances were deemed immaterial and carried forward. Small variances became medium variances. Medium variances became large variances, and eventually, the accumulated variance reached 240 million ounces, a number too large to carry forward quietly. Ernst & Young's footnote isn't an accusation of fraud. It's an acknowledgement that the reported inventory numbers have been unreliable for years, and the magnitude of that unreliability has finally been quantified. 240 million ounces. That's the gap between what the market thought was in London vaults and what actually appears to be there. This is where the lie becomes unsustainable. The implications of a 240 million ounce accounting error cascade through every layer of the silver market. Start with the most basic question. Where is the silver? The LBMA reported total vault holdings of approximately 850 million ounces before the audit. If 240 million ounces of that was an accounting artifact, silver that existed on books but not in physical form, actual holdings are closer to 610 million ounces. But 610 million ounces isn't freely available inventory. Of that total, approximately 480 million ounces is held on behalf of ETFs, SLV, SIVR, and other funds that claim to hold physical silver backing their shares. That silver is allocated to specific bar numbers and cannot be used to satisfy other claims. Subtract the ETF holdings. 610 minus 480 equals 130 million ounces of non-ETF silver in London vaults. Of that 130 million ounces, a portion is allocated to industrial users who have paid for metal but not yet taken delivery. A portion is pledged against loans and cannot be moved without triggering default. A portion is held in custody for central banks and sovereign wealth funds. The freely available unencumbered silver in London vaults, metal that could actually satisfy new purchase orders or cover short positions, maybe as little as 50 to 70 million ounces. And that's after accepting the auditor's revised numbers at face value. The London market trades approximately 200 million ounces per day. 200 million ounces of paper claims changing hands against perhaps 60 million ounces of actual available metal. A ratio of 3.3 to 1 for daily trading volume, not total claims. When you add total outstanding claims, unallocated accounts, forward contracts, lease arrangements, the ratio becomes far worse. Industry estimates suggest total London paper claims exceed 3 billion ounces. Against 60 million ounces of available inventory, that's a 50 to 1 ratio. The 240 million ounce accounting error didn't create this problem. It revealed it. The silver that would have provided a buffer against delivery demands was never there. The numbers that gave participants confidence in the system's ability to deliver were wrong. At 8:45 a.m. New York time on Thursday, CNBC's commodities desk contacted the LBMA for comment on the audit variance. The response, provided by an LBMA spokesperson, was remarkable in its evasiveness. The reconciliation process identified certain historical classification differences that have been addressed through enhanced reporting protocols. Market participants should have confidence that current vault certification procedures accurately reflect physical holdings. Notice what the statement doesn't say. It doesn't say the silver exists. It doesn't say the 240 million ounces has been found. It doesn't explain where the silver went or whether it was ever there. It says classification differences, accounting categories, not physical metal, have been addressed through enhanced reporting. The silver isn't addressed. The reporting about the silver is addressed. The map has been redrawn. The territory remains unchanged. When markets discover that inventory reports were wrong by 29% of annual production, the response is typically violent. The silver market hasn't reacted yet because most participants haven't read the audit. The document was published at 4 a.m., contains no executive summary, and buries the key finding in a footnote on page 34. The information is public but not publicized. This will change. The audit will be discovered by analysts, discussed on social media, picked up by financial media. The 240 million ounce variance will become a story. And when it becomes a story, participants will ask the question the LBMA doesn't want asked. If the inventory numbers were wrong by 240 million ounces, why should we trust the remaining numbers? That question is fatal for a market that runs on trust. If participants can't trust reported inventory, they can't price risk accurately. If they can't price risk, they'll either demand physical delivery to verify their holdings or exit the market entirely. Either response drains liquidity and forces the physical shortage that reported inventory was meant to conceal. Less than 72 hours remain before the London market opens Monday morning. Over the weekend, the audit findings will circulate through trading desks, prime brokerages, and institutional investors. By Monday, someone will test the market, demanding delivery, withdrawing unallocated holdings, forcing the LBMA to demonstrate that the remaining inventory actually exists. The LBMA can satisfy small tests. They can deliver a few million ounces to participants who demand physical metal. But if the discovery triggers a wave of delivery demands, if the 3 billion ounces of paper claims start converting to physical withdrawal requests, the 60 million ounces of available inventory will exhaust in days. While one side explains, the other side positions. The entities most sophisticated about London market dynamics aren't waiting for the LBMA's explanations. They're moving metal. At 3:15 a.m. London time on Thursday, 11 hours after the audit was published, SGE-bound silver shipments from London showed unusual activity. Logistics tracking data showed 4 charter flights booked to transport bullion from London to Shanghai, with combined cargo capacity suggesting approximately 800,000 ounces of silver in transit. This is how informed participants respond to uncertainty about London inventory. They don't wait for assurances. They don't trust enhanced reporting protocols. They move metal to jurisdictions where they can verify holdings independently. Shanghai doesn't have accounting errors. The Shanghai Gold Exchange requires physical delivery within 3 days of contract settlement. Metal is weighed, assayed, and allocated to specific vault locations with real-time inventory tracking. The Chinese system is built on physical verification, not paper trust. The flight bookings suggest that at least some London market participants read the audit, understood the implications, and immediately began extracting metal from a system they no longer trust. At 6:30 a.m. Singapore time on Friday, a major bullion bank, identity not disclosed but described as one of the 5 largest London market makers, reportedly began converting client unallocated accounts to allocated status. Unallocated accounts are claims on a bank's general pool of metal. Allocated accounts are claims on specific bars with specific serial numbers stored in specific vaults. The conversion process requires the bank to source specific bars and assign them to clients. In a market with 60 million ounces of available inventory and unknown conversion demand, the process could quickly exhaust available metal. The bank is apparently converting preemptively, before clients demand it, to avoid being caught short when the audit findings trigger broader conversion requests. When market makers start protecting themselves, retail participants should take notice. The institutions with the best information are acting as if the 240 million ounce variance is not an accounting technicality, but a genuine inventory shortfall with immediate implications. This is what a trust collapse looks like before it becomes a price explosion. The audit finding is public. The information is available. But the market hasn't processed it yet because the publication was designed to minimize attention. That window is closing. Every hour that passes, more participants discover the audit, more analysts read the footnote, more traders calculate what a 240 million ounce variance means for a market with 60 million ounces of available metal. The price explosion, when it comes, won't be gradual. Trust collapses are non-linear. Participants who trusted the system yesterday will demand delivery tomorrow. The 50-to-1 ratio of claims to inventory means that if even 2% of claim holders demand physical metal simultaneously, the available inventory exhausts. 2% of claim holders, that's all it takes. And the audit just gave more than 2% of claim holders a reason to demand delivery. Some will read about the 240 million ounce variance and dismiss it as technical accounting. We'll trust the LBMA's assurances about enhanced reporting protocols. We'll assume that a market operating for decades must have its inventory under control. These are the same voices that trusted Enron's accounting, trusted Lehman's balance sheet, trusted every institution that reported one reality while operating another. The voices are always confident that systems work until they're proven not to work. The audit proves the LBMA inventory reporting didn't work. The voices will explain why it doesn't matter, until it matters. Others will recognize what footnote 17 actually reveals. That 240 million ounces of silver that was supposed to exist doesn't appear to exist. That the inventory numbers used to price risk, to assure participants, to maintain confidence in paper silver's connection to physical silver, those numbers were wrong by 29% of annual global production. The informed are not predicting the price silver will reach or the day the market breaks. Price predictions in trust collapses are meaningless because the range of outcomes spans from nothing happens to market fails to function. What the informed recognize is that the fundamental assurance underlying the paper-silver market, that physical inventory backs paper claims, has been revealed as unreliable. This is not financial advice. This is not a recommendation to buy silver or sell paper claims or take any action based on an audit footnote. This is simply a description of what Ernst & Young found, what the LBMA published, and what the 240 million ounce variance implies about the market's ability to honor claims against inventory that may not exist. The audit is available on the LBMA website, page 34. Footnote 17. Reconciliation variance of 7,464 metric tons, 240 million ounces, published quietly, buried deeply, discovered inevitably. The silver was supposed to be there. The audit says 240 million ounces isn't there. The LBMA calls it an accounting error. The market will decide what to call it. 72 hours until London opens. 240 million ounces missing, 3 billion ounces of claims, 60 million ounces of available inventory. The math hasn't changed. The confidence in the math just died. And when confidence dies in a fractional reserve system, the price of the underlying asset doesn't adjust gradually. It explodes.